This morning on BRN, does private equity belong in your 401k? Joining me now to help break it all down is Jeffrey Hooke of the Johns Hopkins Carey Business School. Jeff, always great to see you. Thanks for joining us on the program this morning.
My pleasure, Jeff. Nice to be here.
Yeah, it's great to talk to you again. And this is such an interesting study I know you and the team put together. Let's just start with some basics here. The 401k has become a very predominant type of retirement program. Typically, there are mutual funds. Sometimes there's a self-directed brokerage account. There is, according to press accounts, media accounts, but also through some of the research that you and others are doing, there's definitely a movement afoot to include private market investments into these retirement plans. I want to get your reaction to that. Do these types of investments belong in these programs, and if so, where?
All right, so for many, many, many years, these private investments were not allowed in small 401ks or personal accounts because the government took a paternalistic attitude, saying that 99% of the population really wasn't sophisticated enough to participate in such investments. So my view basically is that, based on my research and that of others, is there's no point for the average investor to go into these private markets anyway. A simple index strategy for common stocks, or if you want to go into private debt markets, simple debt fund will probably make you more money.
So, but there is a movement. I mean, I don't know if that's just a changing of the guard in terms of administrations. But there is a movement to really install these products into target date funds and other aspects of these plans. Is that just timing, or is there something more to that?
No, it's a change in administrations really that's brought on this particular phenomenon. So without the government allowing these types of investments into what we call retail accounts, which would be average people, that's the slang for average people, retail accounts in the business, it wouldn't happen. But everybody should know all these private equity funds, private debt funds, hedge funds, they've invested with as much as they can with these big institutions like the Harvard Endowment or the California State Pension Plan or the Gates Foundation. All these nonprofits and state pension plans are full up. So now the industry has to move on to greener pastures to continue its growth. So the obvious, really the only target after the big institutions would be the individual investor.
And Jeff, $32 trillion in U.S. retirement assets. So that probably covers some pension, but that also covers defined contribution IRAs. That's a pretty attractive market. I think you would agree, and I think it makes it suits, kind of ties into your point. Will plan sponsors, employers seriously consider adding these products, or should they consider adding these types of products to their plans?
No, I don't think they should. I just don't think that, like I said a minute ago, that they will beat an index fund. That being said, the Wall Street marketing machine is extremely effective.
Yeah, it is.
They've basically walked all over the regulators and the plan sponsors and getting their way in Congress, and they make so much money through fees, not through really making people richer, but through their own fixed fees, that I have every confidence in the industry that it'll basically derail any regulation or obstacles that will allow them to penetrate into these 401ks and other, personal retirement accounts. I'm totally confident they'll do it. There's some legislation on Capitol Hill right now. And there was an article in the Wall Street Journal just this morning where, there's 2 exchanges that are going to be opening that will allow mom and pop to invest in these private equity funds that are usually reserved for only the most sophisticated of investors.
Jeff, these types of investments typically, their valuations are done like they're buy and hold. So they, a private equity investment, they may invest in a business company and they usually hold it for a period of time. How does that play into all this decision making? If you're thinking about what a private equity fund is, how does that play into some of this conversation?
So usually in a retirement account, the individual or the couple, they want an investment that they can sell in a reasonably quick period of time, which is totally the opposite of private equity. So as I said in the article I wrote not too long ago, a couple of weeks it was published, it used to be that the goal of the private equity fund would be to invest, improve, and sell within 10 years. But there's been a very short, sort of short interest in merger and acquisitions for the last 2,
Mm-hmm.
3 years. So the time period is extended now to 12 or 15 years before these funds are sold or liquidated or turned into cash. And I mean, the average man on the street doesn't want to wait 15 years to realize whatever profit, if there is any, on his investment. They want to see something more current. They want to get more current information. All of that is lacking. And when I say 15 years, people say, it's sort of abstract. But let's say you've got a 6-year-old or 7-year-old child. By the time that individual gets out of college, that's the time you might see the end result of your private equity firm. Who wants to wait so long?
I certainly don't. I kind of like seeing the results as they happen. That's just my personal perspective. But Jeff, a lot of these plan sponsors, these employers, for their plans, they have fiduciaries. They're investment advisors. They're investment consultants. Are they kind of a check and balance to just it? Anytime a fund is added to a particular plan, it doesn't. It's not just rubber stamped. It gets evaluated. There's due diligence. You have to explain it to the employer, the fiduciaries, to make the appropriate decision. Does that serve as some level of a check and balance, even though maybe the regs aren't there to do that?
No, not really. No, I mean, those fiduciary obligations you've just discussed, while they're codified into law, so to speak, I the times that you see the Labor Department or the SEC or the Justice Department enforcing some breach of fiduciary obligation of plan sponsor is 1 out of every 10,000. It's basically totally unregulated. From private equity's point of view, that it's the Wild West. There's no sheriff in town. There's no cop on the beat, so to speak. So these plans are going to go into these stop retirement accounts. There may be a little pushback from some extremely paranoid plan sponsors that think they're going to get sued or something. But even then,
Yeah.
who's going to sue them? Some individual? They're not going to have the money to challenge them in court. They'd have to be some kind of class action lawsuit, which means you'd have to wait 5, 6 years to get your money anyway.
So Jeff, as we're in a new administration, obviously different set of rules. What should we be looking for over the next year, couple years, as this opportunity continues to unfold? Will we read more stories? I think you were talking about the Wall Street marketing machine. And will we read more stories about so-and-so adopts this particular product? Will that be what we hear about, or will there be other things that we should be looking at to gauge
No, I think you're going to be hearing a steady penetration of the private equity industry into these retirement accounts. As sure as the sun rises in the east, they'll gradually be pushing into these retirement accounts, which I don't think is appropriate. But I think it's going to be happening simply because there's a lot of money to be made, and that's the whole point of Wall Street's functioning. The people that Trump has appointed to high-level jobs, a lot of them have Wall Street pedigree, so they think they're quite sophisticated and know what's going on. They may be a little conflicted since they work there so long, but I think they are totally aware of the risk to the beneficiaries of these plans.
And is there someone that's going to be looking out for the consumer? I mean, for example, the Consumer Finance Protection Board does research around credit cards. They look at fraud. Is there an entity that will be looking out for the consumers to make sure that they don't get hosed, so to speak?
Not really. I mean, there'd be some class action law firms that might be willing to go up against the most egregious examples of not following, responsibilities as a plan sponsor or fiduciary. Of course, that's, as I said, that's pretty rare. The Consumer Financial Protection Board's been kind of neutered by the
Yeah.
Trump administration, and the Labor Department, even under the Biden administration, has been very quiet. So I think it's consumer beware. Basically, a warning label should be put on these plans, these private equity plans. I'm just a little skeptical. And of course, as you know, as we talked about, it takes 5, 10, 15 years to see how well they actually do. So even if there is some damage over the next few years to somebody's portfolio, they're going to be unaware of it until what's the 2035, I guess.
Yeah, I'm trying to think of 2035. I'm
A
gonna.
long way off.
It's it does, but I'm just trying to think about my future self, and I'm going to be a lot older than I'll be like 65, 67. Well, Jeff, all I can say is it's a great study, great information. Thanks so much for joining us, and look, we look forward to having you back on the program again very soon.
Thanks a lot, Jeff. I really appreciate it.
And don't forget to subscribe to our daily newsletter, The Morning Pulse, for all the news in one place. Details, of course, at our website. And your subscription helps support all this great BRN content. And we're back again tomorrow for another edition of BRN. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.